Good afternoon. This is Tom Asbury with the Viper Report. It's Tuesday afternoon, May 11th. I found this great image before I started last weekend's contribution to Forbes.com. And after looking at the last week's action in the market, this is pretty much how I summed up the reality and the price action, which to me did not mesh. You had companies like Lyft and Uber who didn't do all great on earnings and gave pretty dire forecasts, yet the stock was up 10 to 15%. Then if you see the headlines this week, Uber European rival isn't making profits even after sales plummeted 75%. Uber lays off 3,700 by Zoom. Some of you may recall that in January and February when the market kept moving higher, I didn't think anyone was paying enough attention to the impact of the virus. And now I'm not a believer in this V-shaped recovery that things are going to be back to normal by the fall. I would love to be wrong. In last weekend's article, I featured this long-term chart of the unemployment rate. Of course, it spiked sharply on Friday, and the market was sharply higher. You can see that this 14%, and over the weekend, two administration officials both think it's going to get over 20% next month. It's a pretty good trending indicator. You can see that this chart, the dot-com recession, unemployment rose up into 2003, started to turn lower as the economy recovered. Then in early 2008, the stock market had topped out in October. Unemployment started ticking up, ran sharply up until 2010 before it started to turn down. It's been a long-term downtrend. So 1 month's data does not a trend make, but several months of data, above 5-10% probably will do it. Despite that action, you can see last week the Dow was up 2.6%, NASDAQ 100 up 5.8%. It was now, as of last Friday, up 5.6% for the year. S&P was up 3.5%, etc. Even the small cap Russell was up 5.8%. You'll notice year to date it's still down over 19%. I'm always struck how history repeats itself. In the Forbes article, there's a link in the email. I noticed some of the commentary during the bear market rally from January 1930 up till April. And if you read the press now, you actually see some similar comments. I've seen something about how the Fed easy money is driving a rapid recovery, February 7th of 1930. Market recovering faster than expected, February 2nd. One economist referred to green shoots in the months ahead. And of course, my favorite is the March 4th, 1930. That 1929 thing wasn't a crash, it was a buying opportunity. With an hour and a half to close on Tuesday, the market internals are negative. They were negative on Monday as well, but the market did actually close pretty much mixed. A few indices up, the NASDAQ and the S&P down slightly. Today we have 965 advancing, 1,976 declining. That's not the sign of a strong market. This chart of the Dow shows that this week's action and last week's action, we failed to move above the late April peaks. Only the NASDAQ 100 has made a new high. Below this, we have the MACD. These are the MACD and signal line that are about to cross negative. And more importantly, you can see the histogram, an indicator that I developed, shows a pattern of lower highs. It's been diverging as prices moved higher. That's not a sign of strength. As I pointed out in my special update Tuesday morning before the open, we had 5 sectors that were down on Monday, even though the overall market was up. This is the one that I continue to look the weakest, and I have some short positions in banks, is the XLF. That's the financial market. You can see as of 2/31, it's down 1.76% again today. This formation looks quite bearish. A weak rally. In late April, it failed to get above the early April high. That was a sign of weakness. The MACD for it is also showing this negative divergence, and the on-balance volume has dropped back below its moving average. This market looks like it's set up to be dropped sharply, and it's hard to imagine the overall market going up if the banks get hit. I like to be wrong about the markets, but I try to be a realist. So in the Viper ETF, we have a couple long positions, and we're also long a double inverse S&P ETF, the SDS. And once a break to the downside is confirmed, we'll probably get more aggressive on the short side. Stock traders are long and short until the end of the bear market rally has been confirmed. Then we'll probably transition to mainly short positions. If you'd like specific advice, I hope you'll try one of my premium services. And of course, you go to Viper Report, you can read some of my past articles, what to expect from bear market rallies. And if you're interested in 90 minutes of training with me to see how you can become a more successful trader or investor in 2020, it'll explain the program. I'll do my best to update you by the end of the week. Thank you very much.